We'll get started in just a moment here. Sorry, we'll get started in just a moment. Okay, there we go. So good morning, good afternoon, or good evening, depending on your perspective on the world. And welcome to Coach's Corner. I am Brandon Wendell with the bow tie again, as I am in the photo there. Any excuse to get dressed up for you guys. Love it. So I'd like to welcome you here to our session of Coach's Corner. We're going to talk about divergences and how we can use those in technical indicators to increase our chances for success in really any market. And that's kind of the nice thing about these indicators and price actions. It can work pretty much anywhere that you are doing technical analysis. And with technical analysis, what we're doing is looking for the highest probability of where markets are likely to go. So good afternoon, Kevin. And yeah, so we'll just jump into this. Thanks. Reminds you of Humphrey Bogart, the bow tie. Oh, thank you, Helen. Appreciate that. They're real too. I actually tied this myself this morning. So you see me fidgeting with it a little bit because I'm trying to get it right. But real bow ties will never be perfect. That's what makes them the bow tie. So anyway, getting into this, a couple of things I have to just let everybody know that we are not registered broker dealers or investment advisors. I will be looking at a bunch of different live markets. However, I'm not giving you recommendations, not telling you to buy, sell, or hold those securities or trade the strategies I look at. If you let's see what else am I missing here. Oh, just all investing and trading all investing and trading has risk, and you can't eliminate the risk no matter what you do. You can minimize the risk and work it down a little bit, but it's always going to be there. You can always lose money no matter what. And welcome, Sarah. Yeah, no problem. Anyway, also, free management partners, personnel, and myself included are not subject to trading restrictions, so I can open up a position at security or have a position at security at any time. So that being said, a couple of things I'll let you know about what we do here at Wealth Builders HQ. If you're not familiar already, we have a lot of free workshops. And hello, Ahmed, welcome. Some of the free workshops, Rob runs one every Monday from noon to 1. It's great. You ought to check it out. It's called the Power Hour. And he goes in, talks about what's going on in the markets and a little bit of specific technical analysis, different techniques, things you can use. So he goes over that every Monday from noon to 1 Eastern. Obviously, every Friday, you can join us here again at Coach's Corner. And we rotate between myself and Ryan and Tony. And we also run other programs out there, little premium programs and things if you're interested in. One of my favorites, my little pet project, is the E-mini Think Tank. I run that every Monday, Wednesday, and Thursday. We do a live trading room where we look at the markets in live situations and identify trading opportunities. I do put trades in simulated mode just for legal reasons, so I don't get accused of front running manipulation, things like that. But for the most part, everything's live when it comes to the data and real time opportunities that we see. And there's a lot of education. So if you like what you see and hear today with me here, and you want more of me, that's where you can find me. You're going to find me in the E-mini Think Tank. Speaking of me, and I don't want to make this about me because it's really not, but just give you a background of who I am. I've been involved in trading and investing for over 22 years, which really doesn't seem like it's been that long, but I guess it has. And I got involved in this as a retail broker where I was just simply selling. That's all a retail broker does. They just sell stocks. So I got into back office operations where I was trading for the brokerage as what they call agency desk operator. And that was kind of fun because I started to see, I didn't know it at the time. Looking back, I realized what it was that I was seeing is called order flow. And that's what really drives markets, is the momentum of the orders. And we're going to talk about that today. If we're seeing a lot of bullish pressure, then the markets are likely to be going up because there's a lot of buy orders flooding into the markets and there's nobody there to sell to them. The only way you can buy if nobody wants to sell to you is raise your price, hoping you attract that elusive seller. So you'll see there's a link in the chat there too. If you're interested in joining us in the E-mini Think Tank, you can click on the link. We do a 2-week free trial. If you would decide you want to do a quarterly subscription, you can try it out for 2 weeks for free. We don't charge you. And then the prices are on the site there for it. You can do monthly or quarterly, whatever you want. So you're not locked in. Anyway, so I started seeing this order flow as a trader for the brokerage. And then I got a little more involved. I was hired as a hedge fund trader. So what happened was I left the brokerage, went to a company that taught me how to trade. And I started using that skills and those strategies I learned in the live markets, trading a $50 million hedge fund, which, by the way, a hedge fund of $50 million is tiny. You know, most hedge funds are hundreds of millions or even billions of dollars, but that was an experience. Don't get me wrong. I loved it. Loved every minute of it. But, I got burnt out. It was a little stressful. So it was interesting. I got into teaching trading by accident. I had started trading my own money after I left the hedge fund, and I blew up my account. So blowing up means I lost majority of my money. I didn't lose all of it, but I lost majority. And I wanted to figure out what I was doing wrong. So I went back to the company that I had originally learned trading from and retook the course. I was hanging out there so much that they ended up giving me a part-time job. So I was an assistant for a while. I couldn't teach because obviously I didn't have the background of trading and it wasn't successful. I mean, other people's money I did well. So over time, where I became successful in my own right and traded for myself well, then I eventually moved into teaching part-time, and I still do it. Like I said, I'm in the E-mini Think Tank 3 days a week. And that's really my work week, other than my trading that I do for myself. Even after this workshop, there's still time left in the day. I can get a few trades off in the afternoon. So that's the beauty of being able to trade, especially in the futures markets like I do. There's not a time set like you have in the equities or options where you have to be in front of the computer between 9:30 and 4 p.m. Eastern, or you miss out. I can go in and trade the Asian markets. I can trade the European markets, although not today. Everything's closing. We're the last one. But there's a little more freedom. Now, don't get me wrong. If you're an options or stock trader, you don't have to be in front of the computer all day either, right? You can set up your trades whenever you see the opportunity to sit down and find them and allow the computer to execute for you. But we're going to talk about how we can use some of the indicators that we have to find better opportunities. And that's really what it comes down to. We want to have the odds in our favor. No matter what we try to do in the markets, we can never, ever be right 100% of the time. Okay. And I'm very used to being wrong. I'm a married man, so I'm wrong all the time. She's right, and we're happy. Anyway, so it's actually my second marriage. But so obviously I was wrong before. I hit my stop loss. So anyway, getting back into the markets, we're not going to be right all the time. The only thing we could possibly do is try to increase the odds in our favor. And we do that by some of the analysis that we do. And one of the tools that we have, or many of the tools that we have, is too true, right? Too much. We have technical indicators. And one of the things that I didn't mention it about me, but I am what's called a chartered market technician. Sorry, I keep looking over because there's kayakers going by on the river next to my house. I have a big window here and I can see everybody kayaking. I'll be out there later after lunch. So anyway, with the CMT, Chartered Market Technician, I had to go out and pretty much learn 745 technical indicators. So you see accumulation distribution, ADI or ADX, whatever you want to call it, awesome oscillators, Bollinger Bands, all these different indicators, RSI, stochastics, MACD, it doesn't matter which one you have, okay? The one problem you have with pretty much every single one of these indicators is that it's based on closing prices. That means when you look at the last candle, that candle is still moving. It hasn't closed yet. So the indicator is not actually valid on the current price. So what most people look for when it comes to these indicators, and it's actually incorrect, are crossovers and buy and sell signals. So in order for you to actually get a buy or a sell signal on any indicator, let's take, for instance, stochastics. It's a very popular indicator, and we have two different versions. So you got slow stochastics and you got fast stochastics. I'll just do stochastic. I think it's the fast one here. Let's find out. And let me just disable the other. Oh, not there. No. It's an RSI that I use quite a bit. So anyway, here in the stochastic, what you'll see is you have an upper band of 80 and a lower band of 20. So a typical, and you have two lines right here, %K, %D. And as I mentioned, as a CMT, I actually know what these are measuring. %K is measuring, let's see, what does it sit on? 14 periods, okay? You take a look at the last 14 candles, not including the current one. Well, actually you could, but technically that's not measurable until you finish that candle. But you go back 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. So that green candle is the 14th. So I'll put a vertical line right here. There you go. And basically what that %K is measuring is where is your current close in comparison to the high and low of the last 14 candles. That's all it is. So right now, stochastic should be right around 50%, right? You take a look at the current close, that candle's close, and where you are compared to the high, where you are compared to the low, you're about 50%. What does that read? 50. See, that's easy. Now, what's this blue line? Simple, 3-period moving average of the blue line. That's all it is. It's a moving average of the blue line. And the blue line is where you're closing in relationship to the last 14 candles. So the theory behind this is if you're closing near the bottom of the range, say for instance, we go back 3 candles. Now my range is there to here, right? So where are we closing in relationship to the high and low of the last 14 candles? How about 0? We're at the bottom. That should be about 0. I guess it closed just a little off the low. So that's all that's measuring. But the theory is if you're closing near the lows, you have strong bearish momentum. Now, what happens in this stochastic is they use this crossover thing where you either have these two lines cross over for a buy signal, or you cross above 20 or below 80 to buy or sell. It'll work, but you'll be late because watch what happens. Prices start moving up. And right here, you might be saying, okay, well, there's a crossover I could have bought on this green candle. Nah, not so fast. Because while that candle is forming, these wicks, these lines at the bottom will move. It's not confirmed to have crossed over until the close of that candle. So if you're using stochastics and either using the crossover of those two lines or even the move of the %K above 20, you did not get the opportunity to buy until the open of that candle. You had to wait until it actually confirmed with the close of the previous candle and your entry would have been there. And that can make a huge difference, especially when you're looking at larger time frame charts, right? Oh, hi, Marie. How are you? Yeah, should be on. It is. Anyway, so you can see that you could have bought down here at 41.61. Meanwhile, if you followed the stochastics, you got in at the open of this candle, which is about 41.70. So that's a 9-point difference or $450 out of your pocket that you wasted or waited for. So you got to be careful with using, and this is any indicator. I picked on stochastics. I could have used any, even the RSI that I love so much. It doesn't matter. They're all based on past prices. So the only time you'll get a signal while you are at the opportunity to buy and sell, and by the way, the opportunities to buy and sell, I call them demand and supply zones. I look at the markets a little bit differently than a lot of people do. Those of you who have been in my classes know how I look at the markets with supply and demand. And if you haven't, most people are used to support and resistance, right? And I don't trade that way. I don't use support and resistance. And, let me go out to crude oil, crossed over to next contract. Let's remove the drawing and remove that for now. Basically, what I'm looking for is not support and resistance. Support and resistance are areas where prices have been rejected from multiple times. And it can work to a certain extent, but it's not always the best. For instance, a support line would be somewhere like this, perhaps, where you can see prices touched In this case, it came close, didn't actually touch. But you see, that was an area that touched a bunch of times. The problem with that is that many people believe in support and resistance. The more times an area is touched, the stronger it becomes because more people are buying there. And that's not really true. It's the opposite. And you can see if you try to buy there again, you lost money. So instead, what I look for is a footprint of where the institutions are trading. And where the institutions trade is really where price is likely to go. And got a great question here. Can I explain why I'm using a 15-minute as opposed to a daily or 5-minute? It is just random at this point. What happens with your time frames is that you need to choose whatever time frame you're comfortable trading on based on how much risk you're willing to take and how much time you want to be in the position. If you go back in the archives of the Coach's Corner, which you can actually find on YouTube, if you go out to YouTube and you search for WBHQ, there it is. You subscribe to us. You see I'm already subscribed. And this is live right now on YouTube, as a matter of fact, as we go out. But what I can also do is go back into the previous ones. Let's see, where is it? Let's go to videos. And you'll find one that I did a while back. And not sure where it is right now, but I'm not going to keep going. If I go back in time, you'll find it. But I did one on tuning the risk radio recently and talked about, choosing your time frames. But to put it simply, when it comes to zones that I'm looking for, that's what I'm looking for, is a demand zone or a supply zone. I'm not going to go into it too much in detail right now, but if you do end up joining us at Wealth Builders HQ in the E-mini think tank, you get all that information there. So let me just go ahead and move that out of the way for a second while it logs in personal information. Let's show you something real quick. Get back into this. What I do is I trade using these zones rather than using support and resistance. It just works better for me. So when I go into, so I did the wrong one, E-mini think tank. Again, if you're interested in joining us, great. If not, no big deal. But right here in my material, I have videos that explain it too, but I also have in the fundamentals, my zoning technique and even my pre-trading routine, pretty much everything I do for finding opportunities. So when I trade, instead of support and resistance is supply and demand. So looking at that same area, remember I showed you, and this may not be the best area, but that was possibly a support area where prices stopped going down, they bounced, they stopped going down, they bounced, stopped going down, they bounced. But what I'm looking for is, where are the institutions buying? And I have a specific formula and pattern that I look for. In this case, the zone would be this right there. That would have been my buy zone or demand zone. And you can see we violated just slightly, but I leave some room for that, or have contingencies for that as well. Now, the reason why I do this is, if this is where the institutions were buying, you got to understand how institutions buy and sell. Remember, I was a hedge fund trader and I worked for the brokerage, so I had to do large orders for the brokerage as well. And you can't buy everything all at once. If I'm trying to buy crude oil futures, I'm trying to buy 100 or 200 contracts. If I step into the market and do that all at once, everybody's going to get scared away, because most of the time the orders are anywhere from 3 to 7 contracts at the most on the inside bid and offer. So if I jump in with a bid of 100 cars or 80 cars is contracts, by the way, then everybody would see so much demand and think, wow, this person must know something. This is going to skyrocket. They would stop selling and they would start buying, and I would have nobody to sell to me. So instead, you do what's called working the order. And that's how you get your orders filled. You buy a little bit at a time. So you keep buying, and notice that rallied from that area for 2 reasons. One, somebody was intent on buying and buying a lot. Number 2, if there's no sellers in that area, that buyer had to be aggressive and raise their prices to get anybody to sell to them. However, institutions have a cutoff point. They will buy within a range that they've accepted is a good buying area. If it leaves the area, they wait. They're not like a lot of amateurs that keep chasing price forever and just try to get in. They wait because they know price is likely to fall back to them again. And it did. It came back. They gave them another opportunity to buy. Maybe they weren't done and they bought some more on the third time. But typically what happens with demand and supply zones is after they're tested, they become weaker, not stronger, because you've removed orders from that area. So that's what I look to trade. Now, to answer the question, why am I using a 15-minute candle? You look at the size of the zones. Oh, thank you. The video I mentioned ticked off. Thank you. Yeah, actually, in YouTube, my own personal YouTube, I did a video on that as well. So, if you go back to, YouTube, mentioned, and you go to my channel, I have a few videos. Let's see. Yep, my channel. Sorry. And you can see I've got this ticked off, RSI is a trade filter, follow the market leader, a couple of videos there, a little bit of free education as well. Feel free to look at those if you want. So just search for my name. Oh, getting some more subscribers there. Cool. Anyway, so what's happening here is there's a buy opportunity, prices left. And what I want to point out is right now on this crude oil, I'm on a 15-minute chart and the zone is 11 cents, which means I have $110 of risk. Now, if I go down to a 5-minute chart and look at even at the same area, doesn't have to be a different area. I go back to that same area, what I am likely to be able to do is narrow down the zone. So therefore I would have less risk. And sure enough, there's a smaller zone. There's actually two of them. So now I've got a 5-tick zone. So I went from 11 ticks or $110 of risk to $50 of risk. If I go to a daily chart, I may not even see that zone. And as a matter of fact, you don't. However, one of my nearest buy zones would be way down here. And that is $2 wide. So now I got $2,000 of risk. Or I can look at other zones as well. So the question, why was I using the 15-minute candle? It's just whatever you feel comfortable on. The larger the time frame of the chart, the wider the zones will be and the more risk you will have there. You can compensate for that risk, though, by using different types of contracts like minis or micros or less contracts. So you can balance out the risk and reward. When people ask me what's the best time frame to trade on, there's not an answer other than whatever you're comfortable with, right? So when I'm buying and selling, I'm looking at these zones. And the reason why I brought up the zones as I go back, let's go back to a 5-minute chart on crude oil. It doesn't matter. Oops, I did that wrong. Here's a 5-minute chart. Crude oil took off today. It was a great opportunity if you did the opening range breakout. So if I'm looking for where the institutions are going to buy, if it pulls back, again, I just follow my rules and find my zone. There's one right here. And there's one below it. There's actually one below that too. Oh no, that one doesn't work. The leg out went below. So I've got those two at least. This would be my area where I want to buy. If I'm looking for a signal from an indicator, there is no way I will get any indication while I'm inside that area. The reason why, once again, all the indicators are based on closing prices, and we won't close and give me a buy signal until I leave the area. So if I want to, I can wait for that signal, but I'm going to cost myself extra money. And because I'm entering further away from my target, further away from my stop loss, I will also get less or more risk and less profit. So to avoid that, instead, we can use what's called divergence. And divergence can work on any indicator and any time frame. It doesn't matter which. And I'll show that to you today. So that's what I want to talk about. So again, if you're interested in learning more about the actual zones and how to find them, did I log out of that already? Yeah. You go to the E-mini think tank and join us there. And as I said, there are not just documents. I'm not going to click on them right now, but there's documents on how it works. And there's even videos on it as well that I did, where I recorded some lessons right here. You see bonus videos with the recordings of the class as well. And you can see that we have picking tops and bottoms, targeting, choosing the right targets, trading routine, and finding zones. So you can watch the video, and accompanying the video are the documents that show you how to trade the way the institutions do. And I do that because that's the way I was trained, and it works. More importantly, it works. So that being said, let's take a look at some of the indicators and what we need first of all. When it comes to an indicator, yeah, absolutely. On the 2-week free trial, you can sample everything. Absolutely. It is what happens is if you decide to go in, like I said, there's a link. If you can bring that up again. Yeah, no, we're pretty generous with it. We figure you like it. So if you want to go in on that link, the E-mini Think Tank link that was shown just a little while ago, what you would do is click on that. And at the bottom, there's 2 choices, E-mini Think Tank monthly or E-mini Think Tank quarterly. If you do the quarterly, that's where you get the 2-week free trial. You don't get it on the monthly. There it is. Thank you, Amy. So what happens is you would click on that, you put in your credit card information and all your information, but your card is not charged for 2 weeks. And you do, I believe, you get full access to everything with the videos, all that stuff. So yeah, you can go in and watch the videos and try it out. And then you get the trade room for 2 weeks. And I'm hoping you don't cancel. I hope that you like it and you stay with us, but at least you get 2 weeks to try it all out if you like. And we're pretty generous because I think it's great information and there's a lot there. So anywho, getting back to this, we need to figure out when the indicator is actually telling us to look at it. Okay. And we really want to focus for turning points and buy and sell signals at tops and bottoms in the markets. That's going to be the most important. Where are we turning? Paul Tudor Jones once said, where was it here? Let me see if I can find his quote because I'm going to want to misquote him. Oops. Let's see, Google. Great quote that he had on trading. I will find it pretty simple, pretty soon. Here it is. I believe that the very best money is made at the market turns. Everyone says you get killed trying to pick tops and bottoms and make all your money by playing the trend in the middle. Well, for 12 years, I've been missing the meat in the middle, but I made a lot of money at tops and bottoms. That guy's worth $4 billion from trading. So I think he knows a little bit about what he's doing, right? So that's what we're trying to do is figure out where's the bottom, where's the top. Even if you're in a trend, you still do that, right? You would join in the trend on a retracement, on a pullback, either a rally back up in a downtrend or a drop in an uptrend. So we're still trying to time those bottoms and tops and turning points. So we need to figure out exactly what is a top or what is a bottom so we can use that when we are looking at our indicators to get the right measurements. We start there. So for a top in price, what you have to have is basically a high. It doesn't necessarily have to be a wick. I drew it with the wick there, but it could just be a candle top that closed or even opened at the high. Could be a red candle with a high up there. But what has to happen is before and immediately after, you need to have lower highs and most importantly, a lower low. As soon as that red candle breaks the low of the previous candle, that's your signal that you've put in a top in price. You go to a 1-minute chart, for instance. We go back to crude oil. We'll go to a 1-minute chart, real quick time frame. How do we know when we're, this candle's moving that we put in a higher or low? See, it's changing. It's a live candle. It's a live market chart. So we need to have an objective way of knowing whether a high or a low has been put in. And one of the things you would look for is as candles are moving, I'll go back to this one. Right there, you put in that high and it's higher than the one before. It kind of stands out in the realm of the candles around it, but it's not confirmed as a high until there. As soon as you make a lower high and more importantly, the lower low, right there, as it breaks down, now you can confirm that as a high and you can start using the readings of your indicators at that point. Of course, it ended up being just a small high, but it worked. The other thing that would happen, sometimes you get 2 candles at the same high. And it can look like this, or sometimes there are wicks. The longer the wicks, the better this one is, actually. If you get 2 really long topping wicks that are the exact same height, that's called a tweezer top, because it looks like a pair of tweezers with the 2 prongs sticking up. That's a very strong reversal signal because you hit an area that was rejected not once, but twice by the sellers. So again, when you see the high being put in, this is not confirmed, even if it's more than one candle, until you break the low of those candles, whatever the lowest low was. Right here, you see I had two highs at the same height. I make a lower high, but we had to wait until we made the lower low to confirm that as a top in price. So going back to my example, if I go forward here, we're moving up, and you notice we got a high, same high. That can now be considered to be a top because we made the high, lower high, and most importantly, the lower low right there. And that's almost the exact same example I drew with the two candles making the same or similar high right there. So as soon as we break the low of those candles, that's a top that was put in. Now we look at tops and bottoms again for our indicators and also trend. See, this was not a top. Started to move up, came down, lower high, did not make a lower low. That one was. Highs are the same. There you make the lower low. Now we have a lower high. Another lower high. This candle right here is followed up with the lower highs and lower lows. Here we are again. We're making a high. Now we don't know that's going to be a high yet or a top until we get the follow through. Now we do. Now it doesn't mean it couldn't go higher, but now we can actually use the reading on the RSI to let us know what's actually happening in price. And you can see in that case, it actually tested a second time, third time, and finally went down. The same thing is true for the bottoms, by the way. When you're looking at bottoms in price, you have to put in a low that's lower than the other candles before around it. Then it becomes an official bottom when you make a higher low and higher high. As soon as you cross above, you don't have to wait for that green candle to close. It's while it's forming that you can consider it. And of course, you get the follow through. You can have the same thing if you have two bottoms at the same spot. You wait until the highs of those candles, whichever one's higher, has been violated, and now you can consider it to be a bottom. Oops, hang on. Sorry, I had two French bulldogs, and there's some dogs barking in the neighborhood, so they decided to go berserk. Rushing outside. Oh, stop it, Lucy. Anyway, same thing here, tweezer bottom. She took her toy outside. They're a lot of fun. Anyway, so you can see that this tweezer bottom, same thing as we have with the tweezer top. Price was rejected twice, this time by the buyers, and pushed prices higher. So again, when you have a low put in, you consider that to be a bottom when you have a higher low and higher high afterwards. So same chart. Here, this was a low. And you see there's the higher, well, actually, no, sorry, it was the next one right there, higher low, higher high. You go forward here, let's see, where do we have our bottom? Nothing yet, so we're still making lower lows. You can see, just because we made a higher low didn't mean anything, we didn't make the higher high. Still putting in lows. Oops, went too fast. Right there, now it's confirmed. You had these two lows that were the same. Then we broke to the upside and broke the high of this candle. That's now your bottom right there. Okay. On what time frame are you talking about for gold? Jason was asking, do I think gold is forming a bottom and retouch, kind of like I explained with CL? Depends on what time frame you're looking at. You know, we have, that's funny too. When people ask me, what's the trend? Well, it depends on your time frame. You look at the daily chart, we've had a real significant move down, right? We have two lows at the same level almost, a little bit different. This one is 68.8. This one is 67.9. So that's a little lower. So this one's a little higher. That's not necessarily a bottom yet until we make a higher low and higher high. You would have to wait till Monday for that or Sunday. On the weekly, okay. You can't confirm it to be a weekly bottom yet. However, on the weekly chart, this is at one of those demand zones I was referring to. That's your demand zone right there. We come into that demand zone. So here's a top. high. It wasn't confirmed on this candle, it was confirmed on this candle. But no, that's not confirmed as a bottom yet. Could it be putting in a bottom? Yes, but it wouldn't be confirmed a bottom until we either have another candle that breaks the high of this one or a couple candles that make higher lows and higher highs. But is it probable here? Yeah. There's a high probability of it bouncing here because there's a demand zone. Absolutely. So let's talk about the indicators. Again, it doesn't matter which indicator you want. I happen to use RSI quite a bit. And the reason why, it's relatively simple. The RSI, it's a mathematical calculation that's measuring momentum. And that's all I really care about. And you can do the same thing with other indicators. But like I said, I've got this down. I've been using it for quite a while. And if I put in a horizontal line, it was pretty close. Put it at 50. Basically, what this is measuring is anything above 50. Sorry. Dogs are barking down the street again, or down the canal. I live on a canal, basically on the river. So dogs are barking down the canal. My dog hears it, and you see what happens. So anything above 50, that's measuring bullish pressure. Anything below 50 is obviously bearish pressure. And that would be the same, like I said, with different ones. Yeah, the dogs do try to chase the kayakers, but they're behind the fence, so they can't actually get them. But they do, they bark at them. Everybody loves taking pictures of them. It's funny. I got to be careful because my dog will jump in the water and chase them. So I got a fence. Anyway, like I said, if I bring in another indicator, it doesn't matter which indicator. You know, the CCI is a popular one. They're a crack up. They're two French bulldogs. So let's see, CCI, Commodity Channel Index. Same thing. You've got the midpoint. In this case, it's going to be 0. Then you got bearish pressure below, but bullish pressure above. You can see these are almost identical. That's why I wouldn't use them together. The shape is almost 100% the same. They're measuring the same thing. It's measuring momentum. That's all that matters. Another one that's a little different would be the MACD, or moving average convergence divergence. We are MACD. There you go. Brad's asking, what are the top 3 futures that I prefer to trade and why? Honestly, I love the 4 equity futures. I only trade about 6 futures anyway, to be honest with you. And that would be the 4 equity markets, the NASDAQ, the Dow, the S&P, the Russell. And I also trade, oops, sorry, that screen. Okay, I did that. Didn't mean to do that. I want to change that back. The other ones I trade are gold and oil. And the reason why is I just see really good patterns on those. They just work out really well for me. So the majority of my trades are on the S&P 500 futures. There we go. Anyway, so there's the MACD. I'll keep that up for a moment too. So what the MACD is measuring, which is kind of funky, this blue line is the distance between 2 moving averages from your chart. Those 2 moving averages being the 12 and the 26 simple moving averages thing, unless it's set on an exponential. Now let's put in double A and A. Oh, no, that's not right. Here, I've got them up here already. So I got 2 moving averages. This is to change them. So if you're not familiar, 26, 12. So you see those 2 lines, the 12 and 26 moving average. If the 12 is above the 26, that blue line will be above 0. And what it really is, I'm not kidding, it's just simply the distance between the 2. Get that out of the way. You can see we're above 0. The distance right there is how much the 12 is above the 26. And when the 2 are touching each other, like there, that line is at 0 right there. See? That's all the MACD is. It's a physical line. It's a line showing you the distance between 12 and 26 moving average. The orange line right here is a 9-period moving average of the blue line. Now, what else is funny? Again, remember this line, that blue line, shows you the distance between these 2. What this histogram is the physical distance between these 2 lines. That's all a MACD is. It's showing you how far apart 2 moving averages are, hence the name, moving average convergence divergence. So any of these are going to be delayed for buy and sell signals. If you were trying to buy on the crossover right here, you can see you're buying probably right here, or maybe even on the next candle. Sure, you caught that rally up, but wouldn't you have rather bought back here, well below? You're not going to get a buy signal here because you're using moving averages, which are delayed. They're based on past prices. So the best way to use any indicator, it doesn't matter which one it is, and the only signals you get while you're actually at demand or supply is what's called divergence. We have two different types of divergences and three variations of divergence. We have bearish divergence, which is also called negative divergence, and you have bullish divergence, also known as positive divergence. So bearish divergence usually tops out a bullish trend. It signals the end of a trend, or if it happens to occur while you are at a supply zone, it signals your entry. It confirms the short entry. And all we're looking for is prices are in an uptrend. In an uptrend, prices will naturally make higher highs and higher lows. So in this case, we get price making that higher high. However, remember, this is measuring momentum. It doesn't matter which indicator you have. If it's making a lower high, it means that high was made with less momentum than we had before. That is not a sustainable move. In order to continue in trend, you need to have more momentum, not less. It's just common sense. It's like if you toss this pen in the air, it has inertia, but gravity overwhelms the inertia at one point and they're equal. And then it comes back down to my hand because we lost all the inertia. Now we have gravity pulling it down and creating inertia in the opposite direction. So that's what's happening in a negative divergence. You have three different variations. The first variation is prices are making higher highs. So it's trying to make new moves to the upside, but the momentum is dying off. You don't have the momentum to sustain those moves. A different slight variation of this would be, first of all, again, I showed you what it means. There's less bullish movement on the second high. So the trend's very weak. Now, this doesn't necessarily mean you're going to reverse trend. It will be reversal if you're at a supply zone. If you're not at a supply zone from the higher time frame, then you're just likely to be pausing in trend. And I'll explain that and show you that. Now, the second type of divergence, very similar, but you notice the difference here? We have a higher high in price. The indicator doesn't make a lower high, it makes the same high as before. It's still the same message, though. This may not be as powerful. You still have momentum, just not as much as you did before. Or actually, in this case, it's the same as you did before. But remember, to make new highs, you should see more momentum, not less. And then the other signal you could possibly get is prices making the same highs as it did before. It's just doing it with a lower or less momentum. That's it. All three of those are divergence. Either prices are making higher highs and the indicator either makes lower highs or same highs, or you've got price making same highs and the indicator makes the lower highs. Either way, you're losing momentum compared to what you're doing in price. And you'll see this in, stocks just as easily as futures. Absolutely. Let me get rid of my moving averages. We don't need those. Go into Tesla. Heck, it works in crypto too. Let me clean the chart up here. Remove drawings. And actually, I'm going to get rid of the MACD for right now. Just focus on the RSI. And I'm on a daily chart. See if I can find some divergence. Yeah, here's one right here. Okay, prices are moving up in Tesla. And you can see we made a high right here. I know it's a high because I said so. No, because you have a high and you have a lower high and lower low following it. So now we're moving up again. There's another possible high being put in. And we can see even before the candle closes that we are nowhere near where we were before. That's warning us that there's a lot less momentum than we once had, right? So we go forward, another candle, still not a high being put in because we made the lower high or lower low. And now this is not making a lower low than this candle, though. It is on this one, but it's not on this one. Now we did. So this one came a little late because in order to confirm, you got to have the candle that makes the high being broken. And it finally did there with the open on this candle. And what was left, if you connect the highs, prices made higher high. The indicator, however, did not. And what happens? Because we have less momentum here, prices tried to go up a little bit more, couldn't make any new highs, and eventually collapsed. So it works on Tesla. You know, if I go out to Bitcoin, that's one. Here, oh, no, it's already down. This is not the one I wanted. There's a different one. Yeah. See my watch list. This is one of the charts better. There you go, BTC USD. And actually, that was one of my signals I got before the prices turned down. You can see prices were moving up, pulled back a little bit, no big deal. But right there was another divergence. I was tweeting this out. So if you want to, you can follow me on Twitter as well. I do put out a lot of analysis, especially on futures as well, but I'm at Trader BDub on Twitter. Okay. So anyway, right here, you put in a high. Notice that is confirmed as a high because, I'll zoom in more, prices made a lower high and lower low following that high that was put in, which is higher than most of the stuff around it. Okay. And actually, this was a high that could have been measured as well. Notice we put in a high right there because there's a high followed by lower high and lower low. And you can see that we've got momentum right in this area, just below 50. So we don't have a lot of bullish momentum. Oh, thank you. Yeah, appreciate it. Todd saying that he looks for my Twitter work and he likes it. Thank you. So here's another high. And notice initially the momentum is gaining, isn't it? Right here, you got high and high. And if you connect the RSI, it's showing that that is sustainable because we had a move up with more momentum. That's what you want to see. However, the next move is the problem. Right there. And notice we had more momentum. We kept going higher. We didn't really pull back. We never made a new low. Now we were coming into this area of supply. We have drop-based drop supply. And as we're coming into supply, we're doing it with less momentum than before. That is a problem. You should not have less momentum. You should have more. So when this started breaking down, and the trick is going to be also reading it when you're here. So if I'm doing it when we're there, I don't have the close of the candle. So we could go higher and this could go above 60, but I have to kind of anticipate what I think is going to happen. So at the time we're at the zone, if I notice that we're not getting the same momentum we had before, or we're getting less, I have to anticipate and sell short there. Then I'm confirmed, and now I'm making money. So no, if I'm day trading, I will use as little as the 5-minute chart. I actually day trade on share bar charts sometimes, or tick charts. So I have no problem going down to lower time frames. You see the same thing happen here. There's no divergence. I was looking for divergence. But no, it works on any time frame, as I was saying. I had showed you Tesla, showed you Bitcoin. We can go to ZBU 2021, 30-year bonds. I could do this on a 60-minute time frame. It doesn't really matter what time frame you trade on. Okay, we're getting a little divergence going on right now. Yeah, I use volume charts. I do. Yeah, I like them. So we had a couple of instances of divergence on this chart. One was right here. Prices were trying to go higher. Oh, you're welcome, Boz. And there you can see we're going lower. What happens? Prices drop. You drop when you lose momentum, period. Doesn't matter what chart, what time frame. There you go. I'm going to bring that in. You can see it a little bit better. And this one didn't actually put in a top. That was a high, and we made the same high with a lower low. This one put in a high, never made the lower low, but you can see there's definitely a lack of momentum there. Next thing you know, prices collapse. Those moves usually are not without a warning. Prices go up again, very bullish, no problem. Now we're going up higher than we did before. This is where the problem comes in. Again, it's on the current candle. We are well above where we were previously in price. But is my momentum higher? The answer is no, it's not. And even when we were up there, that was likely to be equal to the prior high. That's a negative divergence or bearish divergence that should lead to a move back down. That's where we are right now on the treasury bonds. So I don't know what the future holds. Now, the same thing happens on the downside. If we're moving down, prices are making lower highs and lower lows. We're seeing that drop in price. However, if we don't have the same bearish momentum, if the momentum is worse or less, I should say, it's lessening, then we're more likely to have a bounce. Okay. So here, indicators are moving down, making lower lows. However, now price is making the lower lows. The indicator makes a higher low. That's indicating that we don't have as much bearish momentum and the trend is weak. We're more likely to bounce. If price makes a lower low, but the indicator makes the same low, very similar, it's just not as weak. Okay, remember, if you make a higher low in the indicator, that's less momentum. Here, we're just getting the same momentum. So it's still not great, it's just not as bad. And finally, if you make the same low in price, but the indicator makes a higher low, you are getting a lot less momentum on that second bottom, and you're not likely to sustain that. That is also a divergence in price. Going back to our charts, we'll see that. I don't see any right now on the treasuries. Let's check out Japanese yen. Actually, we'll do it USD, JPY currencies. So I was saying this can work on pretty much anything. And I just got to find an example of a negative divergence. Oh, there's one. Sure. It doesn't take long to find them. There's a couple. You know, we had price back here. Zoom in more. And clear my chart. In this case, we're moving in a downward trend. We put in a low right here. And we have some decent bearish momentum. We put in another low right there. Notice we broke to the high. And we're not as low as we once were. This is the positive divergence. Prices are making the lower lows. However, momentum is not showing it. And price rallied. Now, was that a reversal or just a correction? You have to look for more signs. One would be, are we at a demand zone from a higher time frame? And let's see, here we are coming down again, trying to put in another low. Compared to the previous low, that's a little bit lower or the same. Doesn't look like we have a lot of momentum here, does it? You can see while we're in this area, in order to be able to succeed and continue below that prior low, we should do it with more momentum, not less. And what happens? Look at that, we reversed. So that was on that dollar yen. Again, it works on any security. Doesn't matter if it's futures, Forex, stocks, eBay. I'm just picking out random stocks, doesn't matter. And we can see that before we get major turns in price, we usually get warning signs, even before it gaps. That was earnings gap. Would it be nice to know before any of these drops that the prices are going to drop? The market likes to tell you right there. You can see we dropped. We made a high right here, started coming down a little bit, made another high. And there's no divergence there, actually. So that one's okay. We should be able to continue on our trend. Oh, we had a pullback. So that one didn't have the warning. It won't always be there. Here's a divergence telling us we're done pushing down. Move to the downside. Move to the upside. And in that case, it was just prices stabilizing for a period of time. Continue down. And another little divergence is quick. two lows. Higher lows. Prices start to rally. Oops, sorry, went too quick here. Right before the earnings date. What do you think is likely to happen? Okay, we don't know if earnings are going to be good or bad, right? Unless you're Martha Stewart. But what I do see is this is not sustainable. Prices went sideways here and the momentum completely dipped. Even though those first couple highs right there, that was a move put in, and that one was confirmed as a high and made a lower high and lower low. That right there is telling you we have lost the momentum needed to continue to go higher. And we are right near a possible supply zone. That combined tells me, I don't think I want to buy this stock. And good thing. Dodged a bullet. So most highs and lows, not all, but most highs and lows will usually have divergence around them. Here's another example. And this would be the only signal you would get while you're at supply and demand. Even on the bottom, you can see prices were moving down, indicator was not. It's moving up. Divergence is powerful, more powerful than any other crossover. Anything else happens late. So, again, if I go into the broad markets, let's go to the ESU 2021. Actually, I'm going to do just continuous contract. Easier. So we look at the big picture here, weekly. And let me clean this up. Actually, I can go all the way back. It doesn't matter what time frame you go to, what period. So there was the crash in 2000, the tech bubble, when it burst. And look at this, the market bottomed out with a divergence. Price making same or higher, lower lows, indicator making higher lows. And you go back up. Yeah, another divergence at the bottom here. Positive divergence, we start going up. When are we going to stop going up? Well, right here's a dip that's coming. Really didn't know until there. Why? Because we had prices moving higher highs while the indicator did not. That's it. It's pretty simple. And we started pulling back. Exactly. When you're unsure of what to do, this can be the little decision maker that helps push you over the edge. So if we go all the way to 2006 and 2007, let me just show you. 2006, pretty bullish. Here we are, November 2007. Prices are moving up. And this was telling me at the time, I was on TV on CNBC back in 2008, talking about the market crash before it actually happened. And you can see why I was concerned about the markets in 2007, because prices are trying to continue going higher without the momentum. There's no momentum there. And what happens? We go up again right here, just on this little bit, mid-year of 2007. That wasn't the peak, by the way, yet. There's warning signs here. Negative divergence. Pulls back. No big deal. We're still bullish here, right? We're not done. And we go higher. Now we make another high right there. And these are the two confirmed highs, right? Because you have a high in price followed by lower high, lower low. High in price, lower high, lower low. And divergence, crash. Bottom of the market. Actually, that wasn't the bottom. This was a small bottom. You can see we had a positive divergence, pushed us back off the lows for a small rally. Yeah, it's not necessarily optimal at 14. It works well for me at 14. You can change it to whatever time period you want. I know some people use 21, but let's see. Oh, best explanation. Oh, thank you. I'm glad you enjoyed the explanation for the tops and bottoms and divergence. So the end of the bottom of the market right here, you can see there was another divergence going on. It happens at pause points. It happens at turning points. That was actually a demand zone from 1996, 97. That's why we bottomed out there where we did. and with a positive divergence. Actually, it wasn't there. It's there. Had 2 divergences in a row. And more recently, would it take longer for the trend to appear? Yeah, the smaller number you use, the number of candles, you get a more sensitive indicator. So you get the turning points a little bit faster, but you got to be careful. I don't lower it more than, I keep it at 14, because if you try to go to 9 or something like that, or 10, it makes it too sensitive to get false info. So you want to be careful of that. But you see here on the weekly chart again, the ES for investors, this was great because it warned you in 2020 that things were getting ready to drop. And sure enough, it did. Even if you caught it on the open of that candle, remember, once you get a close or a price going below your high candle, you're bearish. So if you saw in this week that things were breaking down with a gap down, that confirmed your negative divergence, and you could have gotten out immediately here on the open of that candle instead of suffering. Now we rallied up again. This was not a divergence because we're making lower high on both. Here, prices started going up, and this can keep you in positions as well, because here we're still moving up. We're okay. Now we have divergence. As soon as it breaks the low of that candle, because prices have made higher highs, lower highs. Divergence. That's telling you February of this year, we were going to get a pullback. Was it going to be a crash? No, not necessarily. Again, there's some other indicators and things you can put this together. This is just one piece of the puzzle, but it's a very valuable piece that can help you with understanding price action more. So what happened? Did we pull back? Yeah, it's just a little pullback there. We continue to go higher. Now we're trying to make another high, and we're doing it without the momentum again. Oops. Just want to play this right there. This is not necessarily confirmed, I think, because we have a high here, 49, 249, the high here, 258. Yeah, so I went a little higher. So we still need another candle below that one to confirm. But what do you notice about what's happening with our momentum right now? Every time we've had something like this, we've at least had a pullback, right? That led to pullbacks in price. And that pullback was pretty deep. I mean, 39 down to 37, 200 points. So we could see from, yeah, we could go down to 4,000, close to it on a 200-point move. And we take a look at the NASDAQ, oops, current price, it's the same thing. We've got a divergence. It's not confirmed yet. So what I would have to do is wait for a breach of that candle before I can say it's negative divergence. We're going to have a pullback. You know, as an investor, I don't want to be in and out of my positions very quickly. So I can look at, yeah, I can definitely look at weeklies and monthlies to let me know what's going on in bigger pictures. And that can tell me, or even on the weekly, you can tell me what to expect in dailies and smallers. Absolutely. It's all related. Times are related to each other. So I look at the Dow. And we had the divergence there as well. Well, actually, no. In this one, we just started moving down, but we did have a divergence beforehand here. Don't really have the momentum there. And the Russell, that's been doing a lot of stuff. Remove those drawings. I was doing some old analysis, but you can see we've been diverging for a while. That led to the sideways move. Point it out if you don't see it. Higher highs, lower highs. And now, we're back up again, almost the same highs, but we don't have anywhere near the momentum we need. This is coming down. So yes, I could look at weeklies or even monthlies. Let's say I want to do a British pound. On a big time frame, I can look at a monthly chart just to see what's going on with the momentum. Yeah, right. Oh, that's the Russell. Wait a minute. What happened here? There it is, British pound. So in the British pound, this is kind of interesting. This is actually not a divergence. What happened was that prices made the same high, but we did it with a little bit more momentum. We may end up breaking to the upside here. Remember, the momentum is building, not dying. So we may actually be able to go higher. Here was a negative divergence. Low, lower low. I'm sorry, not negative, positive divergence. I said that wrong. Sorry. Positive divergence, indicators going up. So what would happen? When this confirmed, if you waited for the confirmation, it was when you broke the high of that candle, or you could have seen it a little bit later here with this low and that candle breaking. So you could have been long from 126 up here to the 140s, 138 area. So you can use this in any time frame, any security, and divergence works. I go down all the way to a 1 minute chart. Heck, why not? You're not going to see much on a candlestick here, but you'll still see instances of divergence before prices turn, such as price time to go up, and oops, momentum's not there. Price comes down. There you go. So that's pretty much it I wanted to cover when it comes to the divergence. I don't think I have any other slides really. Nope. I got a lot of stuff here if you want to stay in touch with us. And as I mentioned, if you're interested in learning more about this stuff, I've got a lot of it, obviously. And I teach it in the E-mini think tank. So it's a self-paced type of course. We do 3 days a week live where we analyze the markets, and I do trading in front of everybody. And you can join the link by the link. It's 2 weeks free trial if you want. But if you do the quarterly, so just check it out if you like. There's nothing to lose. And basically, we do trading in there. So let me just show you as well. Into my E-mini trade tracking, show you how we're doing. You know, I track all of our trades. What happens in the beginning of every session is we start off with a trade idea page in the E-mini think tank. Now, in the recorded sessions, that those are bonus and educational sessions we do. Those are education straight, and you learn. And then what we do is in the trading sessions, you get to apply what we learned live in the markets. So for instance, let me just bring up this one. This was last week's trade ideas. It opens up, and I'm not going to give you just the most recent ones. That's not fair. So we go back to some old ones. But what happens is we do this. It's not showing me. Every class starts off with some trade ideas like this, and they vary. Some of them are intraday, some of them are longer term. This was crude oil that we were doing on a 2-hour chart, and we had Bitcoin, micro Bitcoin on a 4-hour chart, wheat on a 30-minute chart. So what I do in every session is I start off showing the screen, and then we dive in to see how did I come to these conclusions? Why do we look at these particular areas? And through that, you get to apply what you learned in the self-paced courses. So it gives you the opportunity not just to learn, but to see a mentor, or get a mentor basically, to interact with and use what you learned in the class. So every day, you see this was another one that we did on June 7th. This one we had no entry because we hit the target first, unfortunately. This one also no entry, all 3 of those that day. Plan now, but sometimes the trade's too good, it just doesn't come to your zone. And what I was also going to show, here's the May tracking. I track every one of those trades. And what I do is I look to see, how many of them won, how many of them didn't, what happened, why we took a trade or not. Target hit before entry, RSI was wrong. So these were our trades from last month of May. And then, it's based on a hypothetical account. I don't take live trades. I do take my own personal trades. I do take live trades because that's what I do for a living. But I also track these in a simulated account to see how it could be done. And you can see May was pretty good. We had, now don't look at that number, 90%. I mean, that's the number of winners versus losers. That's not a big deal. Overall, we had 80% of our trades never got to entry because they never hit the zone. That's all. But out of all the trades, 18% or 9 trades were winners. Only 2% were losers. That's actually a little light for me. I'm usually around 30+%. winners. But the nice thing is this, I had a 2-to-1 win to loss ratio, plus I had a high number of wins versus losses. So I came out very positive for the month. This month, I'm not afraid to show. I don't know how it's doing so far this month. We're at the beginning. Well, no, we're not at the beginning. We're in the middle of the month. Where's it? Here it is. And we've had some pretty good trades. You know, you see there's losers there. I'm not afraid to show losers. And we've got, see, I said I'm around 33, 34% normally, and there I am. So we have 84% winners compared to losers, but really 34% of all my trades were winners for the month so far. And the key thing is I got even better on the win-loss ratio here. That's what I want to be. I want to be at least 3-to-1 on the win-loss ratio, because with a 3-to-1 win-to-loss ratio, you know, your winners are 3 times larger than your losers. That's how you can be under 40% win rate and still be successful, still make money. So we have a good rate of return altogether. Sorry, I'll show you all the numbers because it shows you, depending on your size of your account, what kind of margin you're using, how you could return. But that's what we can do with the tools and techniques if you apply them properly. So that's what I teach in the E-mini think tank. And as I mentioned, if you're interested in being able to follow this on a regular basis, not just learn, but apply, that's a key. You know, a lot of people can teach you things, but you got to make sure that they can help mentor you so you can do it on your own. That's the ultimate goal. And that's what I try to do in the E-mini think tank, because somebody did that for me. Remember, I started off knowing nothing about the markets, and now I'm here, still knowing nothing. Just a little more nothing. No, I'm kidding. I like to have fun. I use one contract for every target. So in looking at this, most of these on the win side might be 2. As you can see, 1 contract, 2 contracts on that one. So it's never more than 2 contracts for a position. That's it to get that account. And that's why I was showing you, if you have an account of $15,000, many of these are intraday, so you can use the intraday margin. And even if they're not, where you had to hold longer, many brokers, depending on which ones you use, you can get out. And if you re-enter after 6 p.m., say you get out at 4:05 p.m., and you get back in at 6:15, you get to use intraday margin the whole time. So that's it. Yeah, I should do 3 contracts with the runner. I know, because you get more out of that, obviously. And you'll see many of these are not hitting target. They're getting taken out with a trailing stop. So sometimes I get shy of the target. I don't get the full win. This one did. Target 1 was hit, but target 2 hit the trailing stop. So I try to get runners, and I just put it on a trailing stop. And the way I trade, I should let you know this, the way I trade is that my initial trade entry, let's say I'm going to trade on the British pound, I might be using a 60-minute time frame. Oops, hit the wrong button there. So if I go to the 60-minute time frame and I look for my zones, British pound appears to be down. So this is hypothetical. I'm not setting up a trade, okay? But hypothetically, if I saw a rally-based drop entry for a short here, my very first target I'm going to pick, oops, wrong button. I do there. My very first target is going to be on this time frame, which is the time frame I'm trading on, right? I might have picked the wrong example. We haven't been this low in a while. Here we go. So there's my first target. I got a buy zone right here. Now, in order to get the big win, I am not going to pick my second target on this time frame. Scale and trail. There you go. That's nice. Get one prayer. But this is how I trade too, in a way, because my first target is always on my same time frame that I'm trading on. The second target, though, I'm going to skip. I'm going to go to a much bigger time frame. I don't go to a 4-hour. Remember, that's my trend time frame. I'm actually going to go to a daily chart and hold on until I hit the daily demand. That's why I end up getting stopped out, because I get a much bigger winner because it's a runner I'm looking for. So there's my first target. Second target now. I don't even see a good zone right nearby. And it's been tested. Oh man, it's down here. Drop. That's not even right. I was thinking it was this, but that's not going to work. It's down here. So there's your runner. So my second target is my runner, because what I do is I get paid on that first target, lock in some profit at the smaller area, and then use the larger time frame. So that way I'm scaling out at the end of the overall move. The reason, and again, it comes down to the way I'm looking at the markets and the way I'm trading. So there it is. I get in here, target one, target two. I'll probably get stopped out along the way when the trade kind of trails out. As you said, scale and trail. So the reason why I do this is on the lower time frame, I call it my zone time frame. Again, this is all in the E-mini think tank. I explain how I trade. This is where I'm finding my zones for entry and exit. In the intermediate time frame, I call that my trend time frame. That trend time frame, trend is the best direction to trade in. Then I have what's called my perspective time frame. And there I'm looking for what's called my field of play. And basically, that is where the trends reverse. So when you think about it, if I'm entering here, I'm going to get some profits right away in my small time frame. Now that I've been paid, it's almost like a casino. I'm playing with the house money. I put away my money that I bet with initially. Now I'm just playing with their house money. So I'm going to keep holding on until the trend ends. And that trend won't end until the end of the field of play on the perspective time frame. So that allows me to get that bigger move. Yeah. If we're a sideways trend, because that can happen too. If we're in a sideways trend, I'll trade and just be very tight because we're buying the lows, selling the highs, and just play back and forth in the trend. And then once you lose, now you know where the trend is going. So you play that trend direction on the breakout. So yes, you can play sideways trend as well. But that's kind of like what you're talking about, where you just, you buy one, or sorry, take some profits on one, but then try to get that big win. My goal, I'll be honest, I'm a lazy trader. I like to work very, very little, but make lots of money. So my goal is to make fewer trades, but make bigger profits per trade. And as I was saying, you kind of see that reflected here in the fact that my loser's $245, my winner's $762. The winners are always much larger on average than the losers, even individually. And that's because I'm looking for that big win after I've taken some profits along the way. So I've got to run. I actually went way over time than I thought I was going to do. So I want to appreciate and say thank you for everybody being here. Hopefully you learned a little bit about price action and primarily divergence and how we can use that as an extra indicator to help us out. If you want to learn more about the RSI and the way I use it, again, it's all in the E-mini think tank. You can join me for that. It's recorded as well, so you can do self-paced. And also everybody gets to contact me. When you go to the E-mini think tank in the members area, everybody can contact me right away, right here. So send me a message. So it's really cool that I try to keep it open with the discussion. And like I said, I'm really here to try to help people do what I do when it comes to the markets, whether they want to do it every day as an active trader or passively looking at the markets from a bigger picture, managing a 401k or a self-directed IRA. I've got experience with all those, and I want to just help people. It's a lot of fun. I joke, I say I'm genetically engineered to do this because my mother's a retired school teacher and my father's a retired stockbroker. So, you blend the genes of a teacher and a broker together and it's what you get. So anyway, I'm going to run. I'm going to get some lunch, maybe go kayaking later. Actually, I watched the end of the market before that too. So I want to thank you again for being here. Hopefully I'll see you in the E-mini think tank. And until then, everyone trade safe and trade well. Take care. Oh, good night from India. Aljo.